Hi, I'm Shiloh Bates, and welcome to the CLO Investor podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. The views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates.
Today I'm speaking with David Altenhofen, Head of Credit Management at Accunia Credit Management. He focuses on European CLOs up and down the stack. We discuss differences between US and European CLOs, CLO Manager Alpha, software loans, and captive CLO equity funds. Defaults in CLO debt are quite rare, but you'll hear about a recent European single B that defaulted. Some housekeeping items. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And I recently put out a YouTube video and white paper on our CLO BBs misrated, which argues that their historical performance has been more in line with default rates of BBB or single A rated corporates. Let me know your thoughts. And if you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with David Altenhofen. David, thanks for coming on the podcast.
Thank you, Shiloh. I'm happy to be on.
It was fun being on a panel with you in London a little while back. How did you end up in the CLO business?
Well, it's a long and boring story, but I'm a trained economist from the University of Copenhagen. I graduated in 2008, early 2008 actually, and spent the first 7 years of my career at the Danish Central Bank as an analyst. And before that, actually, while I was studying, I was a junior analyst at the Danske Bank's macro research. So to some degree, I have a more, you could say, macro research, classical economist background. But then I moved to Accunia Credit Management in 2014. Since then, I have been investing in CLOs and other things with 3 letters such as CLNs, ABS, SRTs. But it is predominantly CLOs I have been doing and we are doing.
Tell us about your firm.
Yes, Accunia was founded in 2008 and actually invested in the first CLO, I think, in 2009. So on the back of, you could say, the great financial crisis, more or less, and have invested since then, more or less, also in ABS, SRTs, and other type of securitized and structured credit. We are a boutique credit manager situated in Copenhagen, and we have approximately 2 billion euros AUM. Our clients are predominantly from the Nordics. They are high net worth individuals, family offices, and so on and so forth. We have a variety of funds, and several of them CLO funds. We have CLO funds with daily liquidity and open-ended funds. We have closed-end funds and so on and so forth. We invest across the cap stack from AAAs to equity. But I would say where we are especially active is in the mezz part from BBB to single Bs.
And that's because that's just the risk return there fits with the mandate of your end investors, or?
Yes, to some degree. I think from the get-go, we are a credit boutique. We are focused on fixed income. We are focused on the cash flow. And hence, I think that's what makes perfect sense for our clients. And I think a combination of a BBB and a BB tranche can give you something like 7%. And that's, what do you call that? The lucky number 7. It's double your money every 10 years. And what we can offer our clients is some sort of, you could call it a wage mandate, but where you get some sort of earning, because many of our clients have locked in capital, be it in private equity, venture capital, and other areas where it's the dividends paid in, you could say, is maybe a little bit different than what we're seeing from the CLO space.
So what you mean by that is that the CLOs are paying like cash distributions quarterly in comparison to private equity or something. You're waiting a long time. That's the J curve to actually get your return. That's what you're saying.
Exactly. Fair point.
So are there other CLO or structured product investors in Copenhagen? I'm sure our listeners will want to know the answer to that very important question.
I think there's a lot. I mean, what I'm hearing, but again, that's of course the banks being polite, is that I think outside of London, setting up meetings in Copenhagen is relatively easy when CLO managers come to town because we have the pension funds and others who invest in the product. And I think part of it is there's a little bit of differences among the Nordic people, and it's just me speaking, of course, but I think the Swedes are a little bit more focused on equity to a degree, at least, whereas maybe the Danes and the Finnish people are a little bit more fixed income. I think part of it is also because actually in Denmark, we have quite a large mortgage bond market. I think it's ranked among the larger markets in the world. So I think actually Danish people on average are quite sophisticated when it comes to various types of structured or securitized credit and fixed income.
So you mentioned that you guys invest in CLOs and then I guess the close cousins to CLOs like the SRTs, the significant risk transfers. What's the most interesting to you these days? Is it CLOs or is it something related?
I think for us, the CLOs remain the, you could say, bread and butter, but we're quite active in the CLN space, meaning that we don't have an ISTA, but that's a way to get access to iTraxx main, iTraxx crossover, where we do tranche investing, which is like the CDX, IG CDX high yield of Europe. So getting access to credit risk that way.
In CLOs, what's the approach that you guys usually take? Are you focused on, well, let's start with just Europe versus US. Are you mostly a European investor?
Predominantly a European investor. I think it's more or less all we do. We have one US CLO fund, but it's relatively small compared with the rest. We have, since the get-go, been focused on European credit for various reasons. I think, one of the things is it's a necessary condition that the CLOs are risk retention compliant. And that part is a little bit difficult because the US market is, you know it better than me probably, but 5-6 times larger than in Europe, something like that.
Yeah, 1.2 trillion in the US.
Yeah, I think we're 300. So, okay, let's call it 4 then. I think today only 20-25% of those CLOs in US, that is, are risk retention compliant. Hence, it's a subset we can invest in. Another thing is we have some ESG restrictions. It's not that we are zealous when it comes to ESG, but we need some sort of language in there. In Europe, I think ESG language is more or less, it's a minimum factor. You need to have it. Whereas in the US, especially in Texas and other places, it takes a backseat. But what we focus on is no controversial weapons, no tobacco, no thermal coal. We don't have an issue in Europe with that. I think it's a little bit different in US. So my long point was just that it's a subset of a subset when we invest in the US. Another thing is we need to hedge, and it's difficult to make a perfect hedge of something where we don't really know when it's called, and it's costly to hedge it. I think for you, it would be more interesting to go the other way around, right?
I'm just a US investor, but my understanding is that the performance of the underlying loans, especially over the last 2 years, has been much better in Europe than in the US. I think it's different for debt because our base rate is higher. So you're getting, higher distributions each quarter from your CLO securities. But if you're an investor in equity, you're seeing in Europe lower defaults and better recoveries, right? Both.
Completely fair points. Another thing is actually, I think also, part of it is the proximity. I think in Europe, we know the companies, we know Verisure, Stark, Ineos, and so on and so forth. I have less knowledge about the US market, to be honest. And another thing is, of course, on the default rates, but you might have a view there on the CLO side. I think S&P, the latest I read from them is that there's like 30 defaults, the CLOs in the 2.0 space, and 13, that's 1-3, potential defaults in the CLO space. Up till now, recently, we had the first one, I think, the first impairment in Europe, but that's very recent. But the US is a little bit different market there, right?
So it is. And if you look back over 30 years, the default rate on CLO BBs is about 23 basis points. It's a de minimis default rate. And if you put it on the corporate scale, it would rate more like somewhere between BBB and single A. The BB performance, and I'm talking about BBs because obviously there are some single Bs in the market, but usually the BB is the junior most debt sold. Investors generally have had a very favorable experience there. But in equity over the last, call it 2 years, the performance in the US has been tough. That's a combination of, higher defaults, poor recoveries, also loans have repriced tighter. So the CLOs just have less income. On top of that, CLO equity, in our view, just trades cheap. That was the setup coming out of last year. And then this year, to add insult to injury, you have the step up in AI capabilities, which could potentially put at risk some of the software business models you find in CLOs. For equity, it's been a tough go.
I agree on that one. I think approximately 4 or 5% of Accunia's AUM is in CLO equity. But it is an area where we find it hard at the moment. I think for the last 6 months, I think we have done 4 trades in CLO equity. And I think 3 of them has been in the secondary market. And that's been on the back of, say, as you mentioned, the weaker prices as of a lower NAV. So I think we have done 1 deal in primary recently. We're looking at a couple of them right now where we can participate in the warehouse. So from the early goings, we need to get some sort of various sweeteners, can you call it that, to make it more interesting.
Your point is, the natural profitability of the CLO out of the gate isn't great. You need to be in a profitable warehouse. You need maybe a manager fee rebate, maybe some concession from the underwriter. In the US, though, the combination of those 3 probably wouldn't be enough to get somebody interested in the primary, like a true third-party investor. Where secondary trades for equity, it's much more interesting to buy stuff in the secondary.
I agree completely. And again, 3 of our latest 4 positions has been in secondary. But of course, we're still looking. And I think in many ways, CLO equity can make perfect sense. And it's, of course, over the cycle. And it's not necessarily just the first or the day one arbitrage, as everybody's talking about. But I still believe, and that's an ongoing discussion we also have internally, is this: if the single B tranche, the 6.5 to 9.5% tranche, is yielding almost 11% in Europe, what should the 0 to 6.5 tranche yield then? Typically, in a new issuance right now, when we do a normal scenario, standard scenario, as we run it in Moody's Analytics and in our own proprietary models, it's high single digits or low double digits. I think that's the issue right now.
In terms of your manager selection, are there any particular hot buttons for you, or what kind of helps a manager to make the cut at your firm?
Without going down the long and winding road, I think it's important to stress that I like CLOs for 3 reasons. And one of them is that the underlying collateral, the loans in Europe, we have seen almost 30 years now of performance. And I think we've had 2 negative years, 2008 and 22. And overall, it's been steady as she goes cash flow from the senior secured bank loans. Being leveraged on that as the CLOs are, fine. And then you have the CLO technology. You have locked in liabilities. You don't have any mark-to-market triggers. The third part is, of course, that you have an active manager. It's a bit like the icing on the cake or the cherry on top, meaning that, again, if you in 2 out of 25 years have had negative return, all else should be fine, depending, of course, where you are in the cap stack and so on. But I still believe that maybe especially over the next 5-10 years, we will see more dispersion in Europe, which we have seen in the US. We will see more tiering. which is another thing. We don't have a lot of, or haven't had a lot of manager tiering in Europe. We are starting to see that now as well, also in primary, not only in secondary. So back to your question, sorry for taking that detour, but in regards to your question, we have a more quantitative way where we do manager ranking every month across 15 variables based on the data from the trustee reports. And hence, it's typical classical credit metrics such as the CCC exposure, the B3 exposure, senior unsecured, second lien, but also like historical data, how much defaults has this specific manager had, and so on and so forth. And we pair that with a more, you could call it a qualitative view on the manager. I mean, the ease of access to the manager, the quality of analysts, and so on. We have several calls with the managers and follow-ups and so on, especially when there's something like software going on. So we use those to combine a whitelist, and then we have a blacklist, a subset of managers we won't invest in. I'm not naming names here, though. Some managers are just a bit more aggressive, maybe is the right word. You could argue that you would like that in the equity part, but I think if you're in the single Bs, double Bs, not so much. And we have also seen that the liquidity of some of those managers in the lower tiers, it's more difficult. It can take days or weeks to sell a bond or a note from those managers, whereas if it's what is viewed by the market as a tier 1 manager, you can sell it in 30 minutes.
For the managers that have outperformed historically, is your view that they have some kind of repeatable alpha or systems that's going to enable that outperformance to continue into the future? Or is it that some managers have just, and would be the cynical view, that some managers have just, for whatever reason, avoided some of the bigger defaults, and that gives them a great track record now, but going forward, their chances of avoiding defaults are just kind of maybe comparable to other managers? And in the US, there's almost 200 managers now, which is hard to believe.
I think in Europe, there's still 75, something like that. We are getting there as well. To some degree, there's also a little bit of luck, because what we have seen historical, and you know that much more in the US, because we have seen more mini cycles, so to speak, rather than like a big credit cycle as we did see during GFC, right? For instance, in US, you had the oil and gas, and you had some managers back then that were overexposed to oil and gas, and they were hit by that, or energy. In Europe, we have had retail in, I think, 16, 17, some managers being overexposed there, and then came Amazon or whatever. Healthcare, we had 22, where the cost shot up, and suddenly healthcare wasn't no longer the conservative or whatever you call that sector. And now it's, as of late, software is another one. Maybe that's the interesting part will be over the coming years, because we have seen some of the, at least in Europe, I don't know how it is in US, you tell me, but in Europe, we have seen some of the tier 1 managers, the so-called quotation mark conservative managers, they have been overexposed to healthcare and software, and they have a little bit of issues right now. If you have 15% software and the market is 8, 9, whatever it is, depending on how you categorize the various credits, that's difficult. And on top of that, you also have chemicals, you have building materials being hit by energy prices. You cannot be over or underweight all these sectors.
One of the things that I've seen that maybe left me a little bit cynical on manager outperformance or alpha is just that every time there's a new cycle or something that's creating kind of winners and losers in the loan portfolio, that it's just a different group that's hit this time. There's not a group of 5% of CLO managers that underperform each year and that they're the ones that buy all the bad loans. That's definitely not the setup.
I completely agree with your point. For me, it's not necessarily about, again, back to the comment about the manager being the cherry on top, because in reality, it's about the CLO technology and it's about the underlying loan market or the collateral. But I think it's not about choosing the winning managers. It's more about avoiding the losing managers. I think that's the point. Like credits in general, you don't need to pick the winners, you need to avoid the losers. I've been doing various types of manager rankings for like 10 years. And honestly, there's many of the same names in the bottom quartile now than was back then.
One thing on the manager performance that is definitely true is that if people think the manager is good and they've outperformed in the past, don't really know if that outperformance is going to continue or not. But those managers do get good debt execution. They do have docs or terms in their deals that are favorable as to equity investors. Whether or not they outperform on the loans or not, the structural benefits at the inception of the deal are very real, of course. When I started doing CLO equity like 15 years ago, I was going to conferences and meeting other people that had like my same job. And one of the things that kind of struck me was I kind of classify CLO equity investors broadly into two camps. So one camp is they've found managers that they've fallen in love with, that they found some, expertise or systems or whatever it is, where they're like, no, I'm doing the CLO equity of these, call it 10 managers or whatever it was. So that was kind of like one camp. And then the other camp was, I just want to buy CLO equity as cheap as possible. I'm not betting on any manager alpha. I know when I'm buying equity cheap, maybe I just met with two CLO managers and don't have any particular view on which one will outperform the other, but I do know through CLO modeling when I'm buying equity cheap, that's kind of like what I'm doing. It sounds like you're kind of maybe somewhere in between those two extremes.
I'm not necessarily convinced that the cheapest equity is always the best, if you know what I mean. I think honestly, it's also about getting various vintage, various managers, diversification. I think that helps.
So in Europe, how much software loan risk is there in the typical CLO?
The market is like 8-9%, maybe a bit more, depending on what you, again, categorize as software. Let's call it 8 to 10. And there are some managers just in the middle of that. And then, of course, as mentioned, there's some very overweight and there's some very underweight.
How are you feeling about the risk there at this point?
I don't know if you got the same impression. I think one of the most said sentence at the credit flux in May was, there will be winners and there will be losers. Let's see. My analysts are covering it, but I think it's more the whole, you don't necessarily run, when you're a CLO manager, you don't run a small mid-cap equity fund. I know some maybe feel like that and they feel like it's great to be overweight, say, software or whatever the flavor of the month is. But I think it's more about being somewhat diversified across sectors and then let the leverage work for you, also for the equity. I think it's still too early to guess where we are going with this. I think some of the managers we've spoken with, the last one we had a call with, I think they had 8% exposure to software, and they mentioned 1 percentage point of that. So 1 in 8 of the software they had, they felt like were in some sort of problems, or especially when there's a refi coming.
That's kind of the take I'm getting from CLO managers in the US, that for the most part, the price action on these loans is that they've traded from like par to like 90 cents. They haven't defaulted. For the most part, they're not distressed, but certainly their risk is up. And there are going to be some incremental defaults due to AI displacement. And that's tough for equity because the default rate was coming down towards the end of the year, which was good news for equity. And now we have this overhang where some companies are going to be winners and some are losers. And in a CLO format, you don't really benefit from the winners. They just repay you at par. The losers stick around and default. I'm not expecting huge defaults from the software bucket, but incrementally, it's going to add a little bit to the pain that we felt over the last 2 years in equity. So at the Credit Flux panel that we did together, we talked a little bit about captive CLO equity funds. So those are funds where an investor commits to do the next, call it 4 deals from one manager in a drawdown structure. Is that like the common CLO equity setup in Europe, or is it more third-party investors like you and me?
The common one is the captive equity fund, to be honest.
So on the panel, I made the argument that captives are pretty bad for our industry. What I was saying was people have committed to these captive funds. The manager is incentivized to form CLOs and to start earning management fees. And they do that irrespective of the initial projected profitability of the CLO. That means too many CLOs are created. It means too much downward pressure on loan spreads because there's just a lot of demand for senior secured loans. And financing costs for CLOs remain elevated or at least above where they would otherwise be, again, because there's such demand for CLO debt. What's your take on that? Do you think that's broadly accurate or?
Yes, I think, as I also alluded to on the panel, I very much agree with your view. Of course, as a third-party equity investor, you could say. But the thing is, I think to some degree, they distort the self-correcting mechanism of the CLO market. Meaning that, normally when the arbitrage, or some years back, when the arbitrage didn't work, you stopped printing CLOs. There was increased because there was not the same type of demand from the CLOs and from the warehouses. On the other hand, limited or finite supply of CLOs out there, meaning that the cost of capital went down and a new equilibrium was found, so to speak, where the arbitrage made sense again. As a true economist, you could say on the one hand side, on the other hand side, I've heard some arguing that the CLOs can keep printing even when spreads are somewhat wider, and that can have a stabilizing effect on the loan market. To some degree, I can follow the argument, but back to my point former when comparing with, say, the single B CLO with a yield of 11, and I know you don't have the optionality on all that, but on the other hand, you do have some sort of subordination. You need to have more than 6.5% losses before you get burned on the single B. There's something there, at least from a third-party equity investor perspective. And I don't know if going forward, if there's room for somebody like you and me in this space. If this keeps going this way,
The percentage of equity that's sold to captive funds, I think it increases every year. And one of the rebuttals to my argument on our panel was investors prefer to do captive equity. That's why there's so much money in it. Who are you, Shiloh, to say that it's not a good way to invest in the asset class? I thought about that, and I think it's a good comment, but I would think about that two ways. So one is that when the market is 20% captives and 80% third parties, the captives aren't a problem for the market. But when it reverses, when it's 80% captive, then the captives are a problem. I don't think there's like a published number on what captive equity is as a percentage of total issuance, but it's certainly a lot now. I think, though, that the reason that so many people have signed up for these funds is that people just aren't aware of how negative the returns will be or have been. What I mean by that is that in our market for equity, as you know, there's like 10 different key variables when a CLO is forming where you can change your modeling assumptions. And basically for any deal, you can find a way to get it to model to low or mid-teen returns. There's certainly some assumptions that'll get you there. The problem is that in the real world, it's hard to get all those assumptions to agree with what you initially wanted. Anybody can say, from a captive fund manager could tell any investor, hey, like I just bought a new CLO formed, you own the equity, and we're targeting mid-teen returns. Like anybody, a very junior CLO person could find a way to pencil out the returns wanted. But the question is, are those going to be the assumptions that actually play out? And my guess is the answer is no. So that kind of enables the fact that you can come up with your own projected returns kind of enables the captives to continue to find investors because they can find assumptions that work. And then the other part of it is just in valuation. So my guess is that in the captives, they're not marking their portfolios to market using secondary market trades. Their investors are not seeing that maybe this CLO bought equity at 90 cents and where a third-party investor like you or I would have cared would have been at 80. And 80 is also the price where this vibrant secondary market that we're in, that's the price. Over time, I would expect, listen, over the last 2 years, CLO equity has been disappointing in general. If you're tied to one manager, unless the manager did some like Herculean job, then you're going to be disappointed. And it's kind of interesting. Like I sometimes talk to investors who are in these captive funds. They think they're doing great. And I'm like, who am I? I mean, it's possible that some of them just happen to be like in the right deals with the right managers. But listen, if you had to bet, your average investor in a CLO captive fund is getting smoked. That would be my base case.
At least it remains to be seen, you could argue. And to some degree, I think the yield you get on the equity, let's call it high single digits, something like that, or maybe even low double digits, whatever you get out, is much better than we have seen for years in the private equity part. So maybe that's what they're comparing it to. In that essence, I think CLO equity is doing fine. We do mark to model. We use an external price source for all our CLOs, and all the CLOs get a daily mark. We can see the changes daily, and we don't do mark to model every quarter or whatever some of these might do. Part of it is just comparing it to the historical returns as of late in the private equity side. And there, I think, and also, I mean, you de-risk in the CLO equity space quite quickly because the cash flow is so front-loaded, right? I still believe it doesn't take away the fact that the arbitrage is just not as attractive as it has been. And to some degree, you need that.
Well, I think also if you're a captive fund, you would have been better off if you're in Europe than the US, again, because the performance of the underlying loans has been better across the pond. The other thing that kind of came out on our panel was, hey, if CLO equity was previously like a mid-teen return opportunity, maybe it's just not that. I mean, maybe everybody needs to settle in CLO equity for a lower return than potentially in the past. But the challenge with that kind of line, or to follow the logic there, is just that, well, there's a double B that's issued by the CLO, and that should set a floor for the return on equity. You wouldn't presumably invest in equity if you could buy a double B and get a similar return. So there's a floor on what could make sense for CLO equity for sure.
Exactly, and I agree. And in Europe, we have the single B. That's somewhat the floor there. What's the spread on a US double B at the moment, Mol?
So it's SOFR plus, call it like 5.5, depending on the deal. And then if you do private credit, which is one of my focuses, it's more like SOFR plus 800. It's a decent return.
Impressive.
I take it you don't do any, I mean, private credit, I think there's only been a few CLOs issued in Europe with that mandate. Did you look at those or?
No, I think for us, it's still too early. I know you like the asset class. It takes time to delve into it, and I think it's too early for us in Europe, at least. I have in the past actually been investing in some US private credit CLOs, but it's a more mature market over there. I think especially now, or maybe right now is actually the right time to build a warehouse and buy some private debt from maybe some BDCs or something like that, right, in the US. There should be some opportunities right now, would be my guess. Without looking at it, you are the expert there, I think.
I think people were kind of expecting that BDCs and private credit funds that are seeing high redemptions will be, a forced seller of assets. I'm not seeing that. That's not my view. And one reason is just that the loans optionally prepay at a 25% rate or thereabouts per year. In the private funds, the typical tender amount is 5% a quarter, 20% a year. So even if these private credit funds don't grow, and I think for the most part they are still growing, just the natural repayment of loans is enough to meet any redemptions. And then they also have like lines of credit, and I'm not expecting to see any kind of fire sale of private credit assets. If there is one, I hope to be invited, but not expecting it. So, David, is there anything topical that we haven't touched on in this conversation?
As I mentioned before, we have now seen the first impairment of a rated tranche in Europe. As mentioned, I think it was 30 till date from 12, 13 in US, and now we have the first one in Europe. We are seeing, my analyst is seeing something like a 60% recovery on that single B tranche. And if under these assumptions, it's something like 3% IRR from issuance back in 18. It's not great, but it's not terrible either, I think. If it's the one single B out of, I don't know how many it is now. Is it 950 we have issuances in Europe, I think. In the 2.0, I think that's actually quite okay.
Agreed.
And then another thing, we are collecting data daily on BWICs in Europe, and I think an interesting part has just been that actually in the MES part, the single B tranche has been the most BWICed tranche across triple Bs, double Bs, and single Bs. I think that's been an interesting de-risking from investors or value rotation out of Europe into US, but at least I think it's been like 900 million euros we have seen on BWICs and single Bs this year, which is more than both double Bs and triple Bs. And it is the tiniest tranche in the whole stack, so it's actually quite interesting. But it's worth noting that the DNT part on that is also somewhat higher than what we have seen on double Bs or triple Bs, at least year to date.
Do you know why single Bs are much more common in Europe than the US?
I probably heard some argument once, but I tend to have forgot that. Maybe it's about the underlying diversification. I don't know if you're more diversified in US. So maybe there's something about detachment. Honestly, I don't know, actually.
For like a US broadly syndicated CLO, it's 8% equity. In Europe, what's the comparable number?
Now it's actually down to like 6.5%, 7% equity. So we're somewhat more levered now.
Okay, so the single B is replacing some of the equity in the cap stack.
Exactly.
What's the single B rate today for like a new issue spread?
Euribor plus, I think 850 would be from a normal manager in quotation marks. But I mean, we have seen some above 900 or so, and we have seen a few maybe with turbos. But I think 850, 860 would be my best guess, plus Euribor. But Euribor is something different here than over at your place.
So our base rate's like 3.7 for SOFR.
You still get 10, 11% on a single B. I think especially in the single Bs, because that's also a little bit more, let's call it esoteric tranche, because it's quite thin. And the investor base there is also quite fickle. Some US hedge funds like that play, but when they're gone, suddenly there's not a lot of buyers back. And we have actually de-risked our exposure. We had, I think, close to 20% in our main fund, double B, single B. We had 20% single Bs, and now it's more like 12, 14. So we have de-risked a little bit following all these things going on.
Great. So David, my closing question is always describe a CLO in 30 seconds.
At the risk of sounding like ChatGPT, first of all, it's not an asset class, it's a technology, right? Second, a CLO is like a bank, but it's a well-designed bank. You have locked in liabilities for, let's say, 10, 12 years. So you cannot have a bank run like a normal bank, and you have the assets where you can sell those loans. Let's call it T plus 20, T plus 60, something like that. A well-built bank with covenants that makes it difficult to get too much exposure to one sector, too large exposures to single names. So I think it's, in many ways, a very fine bank with a finite life.
Well, David, thanks so much for coming on the podcast. I really enjoyed it.
Thank you. Likewise. Take care.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any Flatrock Global Fund. All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities, or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com. This material is for general information purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any security. TCW, its officers, directors, employees, or clients may have positions in securities or investments mentioned in this publication, which positions may change at any time without notice. While the information and statistical data contained herein are based on sources believed to be reliable, we do not represent that it is accurate and should not be relied on as such, or be the basis for an investment decision. The information contained herein may include preliminary information and/or forward-looking statements. Due to numerous factors, actual events may differ substantially from those presented. TCW assumes no duty to update any forward-looking statements or opinions in this document. Any opinions expressed herein are current only as of the time made and are subject to change without notice. Past performance is no guarantee of future results. All investing involves risk, including the potential loss of principal. Market volatility may significantly impact the value of your investments. Recent tariff announcements may add to this volatility, creating additional economic uncertainty and potentially affecting the value of certain investments. Tariffs can impact various sectors differently, leading to changes in market dynamics and investment performance. Copyright 2026 TCW.